Imagine a snowball rolling down a hill, growing larger and faster as it picks up more snow. This is the essence of dividend investing. Picture this. You start with a small investment, represented by a tiny snowball. As it rolls down the hill, it picks up more snow, just like your investment grows when you reinvest the dividends. This is the power of compounding, a fundamental principle of dividend investing. When you reinvest your dividends, you're essentially using your earnings to buy more shares of the same stock. These additional shares then generate their own dividends, which you can reinvest again. This creates a cycle that can significantly accelerate the growth of your investment over time. Now let's take it a step further. Not all dividend stocks are created equal. Some companies consistently increase their dividends, which can supercharge your investment's growth. Think of it like a steeper hill. The snowball rolls faster and becomes bigger in a shorter amount of time. Choosing stocks from companies that regularly increase their dividends is a key strategy in dividend investing. By doing this, you're not just relying on the initial investment and the power of compounding, you're also benefiting from the regular increases in the dividend payout, which, when reinvested, can contribute to the snowball effect. The beauty of this strategy is that it can work in different market conditions. Whether the market is up, down, or sideways, those dividends keep rolling in, and you keep reinvesting them. It's a way to build wealth slowly, steadily, and often more safely than other investment strategies. So, just like a snowball gaining momentum, your investments can grow exponentially over time with the power of compounding dividends. Let's turn our attention to the retail giant Costco. A beacon of consistency in the retail sector, Costco has recently announced a significant 13.7% increase in dividends, bringing its payout to $1.16 per share. Despite its seemingly high price-to-earnings ratio, Costco remains a sound investment, and here's why. Costco's performance over the past year has been nothing short of impressive. The stock has risen nearly 50%, demonstrating its resilience and adaptability amidst a rapidly changing retail landscape. But it's not just the stock's upward trajectory that makes it a compelling investment. The company's robust financial position is another key aspect to consider. Costco's substantial cash reserves far exceed its short-term debt, a testament to its prudent financial management. This financial stability not only enables Costco to weather economic storms, but also allows it to reward its shareholders periodically with special dividends. The ability to pay special dividends on top of regular dividends is a clear sign of a company's financial strength. It's an added bonus for investors, who not only benefit from the stock's appreciation, but also receive a steady stream of income through dividends. And let's not forget about Costco's business model. The company's membership-based structure creates a loyal customer base, providing a steady stream of revenue. Its focus on bulk sales also allows for lower costs and higher margins, further bolstering its bottom line. All these factors, combined with Costco's commitment to consistently increasing its dividends, make it a formidable player in the retail sector and a worthwhile addition to any dividend investor's portfolio. In the world of retail, Costco's consistent dividend increases and robust financial health make it a compelling investment. From retail, we shift gears to the banking sector, focusing on J.P. Chase. This titan of the financial world recently made waves with a 10% increase in its dividend, raising the payout to $1.15 per share. This move signals a commitment to returning value to shareholders and evidences the strength of the bank's financial position. Over the past year, J.P. Chase has shown significant growth, a testament to its robust business model and strategic initiatives. This growth story, however, is not without its hiccups. The banking giant recently released an earnings report that indicated softer guidance for certain business segments, resulting in a temporary dip in the stock's price. But let's take a closer look. The dip following the earnings report may have startled some investors, but it's essential to remember that the banking industry is cyclical and subject to fluctuations. Moreover, the soft guidance does not necessarily reflect a long-term trend, but could be a result of transient market factors. Despite these challenges, J.P. Chase's dividend growth remains strong. The bank's consistent commitment to raising its dividends is a positive sign for investors. It indicates that the bank is confident in its ability to generate sustainable profits over the long term, providing a steady stream of income for those who have chosen to invest. J.P. Chase's dividend increase is not just a number. It's a testament to the bank's resilience and its ability to navigate through market volatility while keeping the interests of its shareholders at the heart of its operations. For investors, this could be a sign of a reliable and potentially rewarding investment. Despite some recent turbulence, J.P. Morgan Chase's dividend growth remains a positive indicator for investors. So while the banking sector may have its ups and downs, one thing is for sure. With J.P. Morgan Chase, you're banking on a history of consistent dividend growth and a future that looks promising. Next on our list is a company that's been a consistent dividend payer for over 6 decades, Procter & Gamble. A titan in the consumer goods industry, Procter & Gamble is no stranger to the dividend game. With a track record spanning 6 decades, the company has been a steadfast provider of dividends to its shareholders. And it's not just about the length of time, but also the consistency and growth. The company recently announced a dividend increase of about 7%, bringing the dividend to now 1.0065 per share. This is a continuation of a staggering 67-year streak of dividend growth. But what makes Procter & Gamble a compelling case for dividend investing goes beyond just the consistency. It's about sustainability. The company maintains a healthy payout ratio, a key metric that shows the proportion of earnings a company pays its shareholders in dividends. This ratio is a clear indicator of a company's ability to keep paying dividends in the future. A healthy payout ratio suggests that the company is not stretching itself thin to maintain dividends, but rather it is adequately balancing its obligations to shareholders and its need for reinvestment for future growth. Procter & Gamble's ability to consistently increase dividends while maintaining a healthy payout ratio is a testament to its strong financial health and prudent management. It goes to show that the company is not only able to generate consistent profits, but also efficiently allocate its earnings between reinvestment and shareholder returns. In the world of dividend investing, consistency is key, and few companies exemplify this better than Procter & Gamble. With its consistent dividend increases and a healthy payout ratio, the company offers a compelling case for dividend investing, making it a worthy consideration for anyone looking to build a portfolio that generates steady income over the long term. With its consistent dividend increases and healthy payout ratio, Procter & Gamble offers a compelling case for dividend investing. Now we delve into the world of real estate investment trusts, focusing on Agree Realty Corporation. Agree Realty Corporation, also known as ADC, operates in a unique sector that comes with its own set of challenges. Like many other real estate investment trusts, ADC has been navigating the treacherous waters of a high-interest rate environment. This situation can put pressure on stock prices, making it a test of resilience for any corporation. Despite these challenges, ADC has managed to not just stay afloat, but also to increase its dividends. In a recent move, ADC hiked its dividend by 1.2%, amounting to 25 cents per share. This may seem like a small increment, but in the world of investing, every cent counts and contributes to the compounding effect of dividend reinvestment. But ADC's strategy doesn't stop at increasing dividends. The company has also transitioned to monthly dividend payments. This shift is significant as it allows investors to enjoy a more frequent income stream. It also offers the potential for faster compounding when these dividends are reinvested. Imagine it this way: if dividends are the seeds you plant for future growth, then the more often you can plant these seeds, the more bountiful your harvest can be. ADC is essentially giving its investors more seeds to plant more frequently. It's a strategy that, despite the high-interest environment, is designed to optimize the compounding effect and maximize returns. This approach showcases ADC's commitment to its investors. It's a testament to the corporation's strategy of not only surviving in a challenging environment, but also ensuring that its investors continue to see growth. It speaks volumes about ADC's financial management and its outlook towards the future. Despite facing headwinds, ADC continues to reward its investors with consistent dividend increases. So as we see, even in a high-interest environment, there are ways to navigate the storm and keep the ship steady. Last but not least, we turn our attention to the energy sector with Phillips 66. This is a company that has been making waves in the oil and energy sector, and is a shining example of how a volatile industry doesn't necessarily mean a volatile investment. Phillips 66 recently announced a 10% increase in its dividend, taking it to $1.15 per share. Now, this might raise a few eyebrows. After all, the energy sector is known for its ups and downs, and fluctuations in free cash flow are par for the course. But here's where Phillips 66 stands apart. Despite these fluctuations and the inherent volatility of its sector, Phillips 66 has managed to not just maintain but increase its dividends. It's a testament to the company's robust financial management and strategic foresight. They've shown an ability to navigate the stormy waters of the energy sector, ensuring a steady return for their investors. But what makes Phillips 66 a viable investment in a volatile sector? For one, it's their diversified portfolio. They're not just an oil and gas company, but also have a hand in refining, marketing, midstream, and chemicals. This diversification helps buffer against the volatility of any one area and provides a more stable cash flow. Moreover, Phillips 66 has a strong commitment to returning capital to shareholders. It's not just about the dividends. The company also has a share repurchase program, which is another way of returning capital to shareholders. This commitment to shareholder returns, coupled with the company's steady performance, makes Phillips 66 a compelling choice for investors. In conclusion, Phillips 66 is a shining example of how, even in a volatile sector, consistent dividend increases and a strong commitment to shareholders can make for attractive investment opportunities. It shows us that with the right strategy and financial management, any sector can yield profitable returns. Phillips 66 demonstrates that even in volatile sectors, consistent dividend increases can offer attractive investment opportunities. In the world of investing, the power of compounding dividends can't be understated. We've journeyed together through the financial landscapes of 5 distinct companies, each with unique strengths and strategies. Costco, with its robust financial position, not only increased dividends by nearly 14%, but also has the capacity to pay special dividends periodically, a testament to its strong cash reserves. Then, there's JP Morgan Chase, which, despite a minor hiccup following its latest earnings report, has demonstrated substantial growth over the past year and increased its dividends by 10%. Procter & Gamble, a familiar name in the dividend realm, continues its 67-year streak of dividend growth, with a recent increase of around 7%. Its healthy payout ratio underpins this consistency, a testament to the company's financial health. Agree Realty Corporation, navigating the choppy waters of a high-interest rate environment, continues to increase dividends, transitioning to monthly dividend payments, a move that could potentially provide a steady income stream for investors. Lastly, Phillips 66, despite the fluctuations inherent in the oil and energy sector, has managed to maintain and even increase its dividends, exhibiting resilience in the face of volatility. These examples underscore the potential benefits of investing in companies that consistently increase their dividends. It is not just about the immediate returns, but also the long-term compounding effect, the snowball effect that can significantly boost your investment portfolio over time. So, as we wrap up, I encourage you to further explore the concept of dividend investing. Look beyond the immediate and consider the potential long-term benefits. Analyze, understand, and then make informed decisions. Remember, just like a snowball rolling down a hill, your investments can gain momentum with the power of compounding dividends. So go ahead, dig deeper into dividend investing and let your investments snowball. Before we officially wrap up this enlightening journey through the world of dividend investing, we want to remind you that our exploration of the financial world doesn't stop here. We continuously delve into a myriad of investment strategies, financial news, and company analyses to help you make informed decisions. So, if you haven't already, go ahead and click the subscribe button to stay updated on our latest videos. And if you found this video helpful, give it a thumbs up and share it with your friends, your family, or anyone who might benefit from this information. Your support helps us create more content like this, and we deeply appreciate it. But our conversation doesn't end here. We'd love to hear your thoughts, experiences, and questions about dividend investing. What companies are you keeping an eye on? Have you experienced the snowball effect of compounding dividends in your portfolio? Share your thoughts in the comments section below. Remember, investing is not just about the numbers. It's about the community, the exchange of ideas, and learning from each other. So let's keep this conversation going. Until next time, happy investing, and may your investments continue to snowball.